Everything seems to be going great. The S&P 500 has been on a 17-year bender, the Federal Reserve thinks they've stuck the landing, and Arby's just released steak nuggets. On the surface, life is good. It looks like we've unlocked the capitalism speedrun where everyone's a genius and every dip is a gift. But underneath that flashy exterior, there's a credit crisis bubbling that nobody wants to talk about. While you're watching some broccoli-haired teenager on TikTok flaunt a rented Lamborghini, the reality is that the average American is managing several credit cards, several monthly payments, and several financial headaches just to stay afloat. Today, we're diving into the great paradox of 2026. Because the truth is, becoming rich has never been easier, and yet, actually staying rich has never been harder. And by the end of this video, I'm going to show you how the smart money is quietly repositioning while everyone else is busy pre-ordering hope. Let's start with the easier than ever part. 20 years ago, if you wanted to trade stocks, you had to call a guy named Rick on a trading floor and pay a commission that would make a loan shark blush. Today, you can wake up, see a hot stock tip from some guy on Twitter, or from me, and deploy capital before you've even finished brushing your teeth. We are living through the greatest bull market in human history. 17 years and over 700% returns. In this environment, investment strategies characterized by high beta and irrationality haven't just worked. They've generated alpha. It's the era of Dave, our favorite retail toddler who just discovered options. Dave doesn't care about earnings reports or cash flows. He has a hustle harder poster and a strategy built on prayer. And for a long time, Dave was winning because when liquidity is a fire hose, even the dumbest investors look like George Soros. We've democratized access to everything. You want exposure to private credit? Wall Street's $2.5 trillion secret industry is now open for business. You want to bet on the colonization of Mars? The SpaceX IPO is coming, and they've literally rewritten the rules of the NASDAQ to make sure your 401k can be the exit liquidity. The barrier to entry isn't just low, it's non-existent. But here's the gut punch. While the top-line numbers look healthy, the foundation is beginning to crack because this so-called growth is really just fueled by a consumer debt crisis. America isn't saving for the future, it's financing the present. Total household debt has exploded to over $18 trillion. We've got record highs in mortgage debt, auto debt, and student loans, the herpes of the finance world that never truly go away. And then there's the ugly bucket, credit card debt. We've added more credit card debt in the last 4 years than we did in the entire decade following 2008. Translation: people aren't spending more because they're earning more, they're spending more because they're borrowing more. They're spending more because they're borrowing more. We're using plastic poison to hold our lifestyles together while cumulative inflation has eaten 25% of our purchasing power since 2020. So while it's easy to look rich by swiping a card, the math says you're actually just a few interest rate hikes away from looking for a job at Payway. This is the part of the video where I'm going to start to dive into the important details. For most of history, markets were anchored to boring adult stuff like earnings and economic data. But since the pandemic, the relationship between prices and fundamentals has felt loose. It's like they're technically in the same room, but they aren't on speaking terms anymore. We've entered a new regime where markets don't price cash flows, they price attention. If you try to talk about intrinsic value today, you get the same reaction as someone asking a DJ to play Nickelback. Even Michael Burry, the guy who literally inspired The Big Short, shut down his hedge fund because he realized the market can stay irrational longer than he can stay solvent. We're staring at a top-heavy market where just 7 tech companies, the Magnificent Seven, make up a third of the S&P 500. It's the nifty 50 bubble of the 1970s all over again, just with shinier special effects. We're pretending valuations don't matter while whispering the 4 most expensive words in the English language. This time it's different. So why is it harder than ever to stay rich? Because we're living in the largest real-time experiment of the greater fool theory the world has ever seen. Whether it's Bitcoin, which fails every basic test of being actual money, or strategy, formerly MicroStrategy, trading at a 100% premium just to be a glorified Bitcoin vault, the value is entirely dependent on the belief that some bigger idiot will buy it from you for more money tomorrow. And while everyone is busy debating the next meme coin, the global financial system is quietly rewiring itself. Central banks are dumping the dollar at the fastest pace since 1992 and piling into shiny rocks. They aren't just diversifying, they're strategically tiptoeing out of the room like like they're trying not to wake a sleeping dragon. The exorbitant privilege that allowed America to borrow at the cheapest rates on Earth for 80 years is disappearing. New systems like the Unit and Bridge are being built by the BRICS nations to route around US dependence. Optionality is a monopoly killer, and for the first time since World War II, the world actually has other options. The moral of the story is this: the metrics we use to measure wealth have become targets, and because of that, they've stopped being good metrics. Goodhart's law is in full effect. We're optimizing for the headline unemployment number while job quality disappears. We're maximizing GDP while the average person is drowning in debt. Being rich in 2026 isn't about how much you can borrow or how many green P and L screenshots you can post. It's about understanding the mechanics of a broken system. It's about realizing that liquidity is the oxygen of the markets and the tank is running low. So, I want to hear from you. Do you think 2026 is the year the greater fool experiment finally runs out of fools? Or are we just getting started in this feedback loop of algorithms and madness? Drop a comment below. I'll be responding to as many as I can. And if you're tired of traditional media giving you the dumbed-down version of the truth, hit subscribe. Because the real threats in the market aren't the loud ones. Those are priced in. The real threats are the ones hiding in plain sight. I'll see you in the next one.